Ever wondered what bonds and bond ETFs are and how they work exactly? And how this key component of any long-term investor's portfolio can generate stability and returns wisely? Well, stay tuned as we explore some critical learnings that will help you maximize the use of bonds in your portfolio. Let's begin our exploration into this fascinating world of finance. Bonds, at their core, are a kind of loan. But instead of you borrowing money from a bank, you're the one lending your money to an entity, which could be a government or a corporation. When you buy a bond, you're essentially giving a loan to the issuer of that bond. In return for the money you've lent, the issuer promises to pay you back the principal amount at a certain date in the future, known as the maturity date. In addition, they also agree to pay you interest, often referred to as the bond's coupon, at regular intervals until the bond matures. Now, what about bond ETFs, you might ask? ETF stands for Exchange Traded Fund. A bond ETF is like a basket, a collection of different bonds. Just like a fruit basket can contain a variety of fruits, a bond ETF can hold a variety of bonds. This could include government bonds, corporate bonds, or municipal bonds, among others. And here's the interesting part. Just like stocks, these bond ETFs are traded on an exchange. This means you can buy or sell shares of a bond ETF just as you would with shares of a company. The main advantage of a bond ETF is that it provides you with the ability to invest in a diversified portfolio of bonds with a single transaction. So why are bonds and bond ETFs important? They serve a dual purpose. For entities like governments or corporations, they provide a means to raise funds for various projects or operational needs. For investors, on the other hand, they offer a way to earn returns on their investment. Bonds and bond ETFs thus play a pivotal role in the financial ecosystem. They bridge the gap between those who need funds and those who have funds to invest. So bonds and bond ETFs are an integral part of the investment landscape, providing a way for entities to raise funds and for investors to earn returns. Now that we have a basic understanding of what bonds and bond ETFs are, let's delve into the three main types of bonds based on duration. Firstly, we have short-term bonds. These typically have a duration of 1 to 3 years. The primary advantage of short-term bonds is that they are, in general, the safest. Why? Well, they're a bit like trying to predict the weather for tomorrow. We can usually make a fairly accurate guess based on the conditions we see today. Similarly, with these bonds, we're looking at a relatively short future time frame. We can make reasonable predictions about what might impact the bond's ability to pay back its value, or the likelihood of changes in economic conditions, interest rates, or government policies. So, the closer we are to the present, the lower the risk. Next, we have intermediate-term bonds. These have a duration of 4 to 10 years. Now, predicting these is akin to forecasting the weather a week from now. It's a bit trickier, isn't it? That's because there are more factors and a longer time frame that could influence the outcome. The same goes for intermediate-term bonds. They carry a bit more risk because there's a longer time frame for things to go awry. But remember, with greater risk often comes greater potential return. Lastly, we have long-term bonds. These are bonds with a duration of over 10 years, sometimes as much as 20 years or more. Forecasting these, well, that's like predicting the weather a year from now. Quite challenging. There's a very long time frame for things to change, and a lot of factors that could influence the bond's performance. Consequently, long-term bonds carry the highest risk. But again, the potential for higher returns is there too. Now, you might be thinking, why would I invest in a bond with a higher risk? Well, it's all about balance. A diversified portfolio often includes a mix of bonds across different durations. This way, you're not putting all your eggs in one basket. And remember, higher risk can lead to higher returns. So, while long-term bonds may be riskier, they could also significantly boost your earnings. Let's also not forget that the credit quality of the bond issuer plays a crucial role too. For instance, bonds issued by the government or strong, stable corporations are generally considered safer than those issued by less established companies. But even bonds from companies with a lower credit profile, often called junk bonds, can offer a good risk-reward profile for the discerning investor. So, to sum up, the duration of a bond plays a pivotal role in determining its risk and potential return. It's a key factor that you, as an investor, need to consider alongside the credit quality and interest rate associated with the bond. The duration of a bond plays a significant role in determining its risk and return profile. If you've made it this far, please consider giving us a like and subscribe to support our work of helping wise investors. We really appreciate it. With any investment, there are risks involved. Bonds are no different. In this world, there are no guarantees, and even the seemingly safe haven of bonds carries certain risks. Let's discuss these in more detail to help you make informed decisions. The first main risk associated with bond investments is credit risk. This pertains to the quality of the issuer, meaning their ability to repay the bond. The higher the quality of the issuer, the lower the credit risk. Now you might be thinking, how do I know the quality of the issuer? Well, it's usually labeled and rated within the marketplace. For instance, US government-issued bonds, often referred to as Treasury bonds, are generally considered to be of the highest credit quality. This is because, in theory, the government would never default, failing to pay back the original face value or interest payments tied to the bond. However, even these come with a degree of risk, albeit minimal. Then we have corporate bonds. These are issued by public companies that, while often strong and stable, use the debt market to finance projects or other debt leverage goals. The credit risk here is slightly higher than with Treasury bonds, as the financial stability of a company can be more volatile and uncertain than that of a government. At the lower end of the spectrum, we have what are called junk bonds. These reference bonds issued by companies with the worst credit profiles. While the credit risk is high, they may offer a good risk-reward profile for discerning or opportunistic investors and shouldn't necessarily be ruled out. The second major risk is interest rate risk. This refers to the impact of interest rate changes on a bond's value. As we've seen recently with rapid interest rate hikes by the Federal Reserve and other global central banks, such actions can damage bond values, particularly long and intermediate duration bonds. This is because when interest rates rise, bond prices fall, and vice versa. And this brings us to our third risk, duration. The further out a bond's maturity date, the higher the risk. Why? Well, predicting what could go wrong in the future that would impact the bond, such as defaulting or not being paid back, or the economic outlook on interest rates, global conflict, or other government policy actions, becomes increasingly difficult the further out we look. For example, if we were to try to make predictions about these factors 3 years out, the risk is relatively low, because we're better at seeing things sooner. But if we were to try to make predictions 7 years out, or 20 years out, the risk increases. It's like trying to predict the weather. The further out we forecast, the less reliable our predictions become. So as a bond investor, understanding the duration of a bond is key to assessing its risk. Short-term bonds, particularly government and corporates, are generally the safest, while long-term bonds carry the highest risk. These interdependent factors, credit risk, interest rate risk, and duration risk, all contribute to the overall risk profile of a bond. Many investors question, and rightfully so, whether bonds are a good long-term investment, particularly in times when interventions by the Federal Reserve and other central banks appear extreme and potentially distort the bond market. Understanding these risks is crucial to making informed decisions about bond investments. So, whether you're a seasoned investor or just starting out, keep these risks in mind as you navigate the complex world of bond investing. A final question investors may ask is, so what does the research say about formulating the best risk versus reward in terms of bond duration? Well, Vanguard's perspective, shared in the link in the description, outlines additional research and makes the case that intermediate, high to medium quality credit bonds or core bond funds may be the best option. While short-term bonds of late have yielded very high relative returns, the intermediate category of bonds over longer period timeframes tend to reward investors with both current dividend payments along with price appreciation. So, wise investors could do well by evaluating their cash and short-term bonds for a bit longer duration, and even review the idea of rebalancing from overweight mega-cap tech into intermediate core bonds. So, let's recap what we've covered in this video. We've delved into the world of bonds and bond ETFs, understanding their role in the financial market. We then explored the three main types of bonds based on duration: short, intermediate, and long-term bonds. Remember, duration is not just a measure of time, but a critical factor influencing risk. We also highlighted the various risks associated with bond investments, including credit risk and interest rate risk. Credit risk essentially refers to the quality of the issuer, with Treasury bonds being the highest credit quality. Interest rate risk, on the other hand, is tied to the impact it has, with the duration of bonds. So, whether you're eyeing government-issued bonds, corporate bonds, or even the so-called junk bonds, always consider the duration and the associated risks. By understanding these fundamentals, you're well on your way to making more informed decisions about bonds and bond ETF investments.